Goals and objectives of the organization are established through the planning function. It is important to ensure that these goals and objectives are accomplished. This is taken care of by the controlling function of management. Controlling involves comparing actual performance against standards and taking corrective measures if necessary. Steps involved in controlling are: number 1, establishing standards; number 2, measuring and comparing actual performance against standards; and number 3, taking corrective action if necessary. Plans are the yardsticks against which controls are devised. However, plans vary in detail and complexity, and as such, it is necessary that certain key performance areas or critical points are identified in the entire planning program. The principle of critical point control states that effective control requires attention to those factors critical to evaluating performance against plans. For example, a 5% increase in material charges in a typical engineering industry may be more alarming than a 10% increase in stationery charges. Once critical points are identified, the next step is to establish standards at these points. These are referred to as critical point standards. Standards are nothing but criteria of performance. Commonly used critical standards or critical point standards includes physical standards that are non-monetary measurements and are common at the operating level and involves use of material and labor. Example, labor hours engaged per unit of output, kilograms of material for producing 1 unit of output, etc. Corresponding money values are expressed as cost standards. Example, material cost for producing 1 unit of output, labor cost for producing 1 unit of product, etc. Capital standards are related with capital investments and are related with balance sheet elements. A commonly used capital standard is return on investment, often referred to as ROI. Revenue standards are related with the monetary value of sales. Program standards are standards used to appraise the effectiveness of a given program. Program may be, say, improving the quality of a sales force. Standards not expressed in either physical or monetary measurement are intangible standards and are more difficult to set. For example, performance of a manager. Goals as standards involves establishment of an entire network of verifiable qualitative or quantitative goals at every level of management. Once performance standards are set, the next step is measurement of actual performance. Performance can be measured by personal observation, as in the case of the subordinates being observed while they are engaged in work, sample checking, study of performance reports, etc. As far as possible, performance should be measured in the same units in which standards are set. Comparison of actual performance against the standards will reveal the deviation between actual and desired results. A well-organized control system will provide for easy comparison of actual performance against standards. Comparison becomes easier when standards are set in quantitative terms. For example, performance of a worker in terms of units produced in a week can be easily compared against the standard output for the week. Some deviation in performance can be expected in all activities. It is therefore important to determine the acceptable range of deviations. Control by exception or management by exception is an important principle of management control. According to this principle, an attempt to control everything results in controlling nothing. The principle states that managers need to control only exceptional variations rather than trying to correct each and every deviation. For example, if plan provides for 5% variation in inventory charges, then a 3% variation in procurement cost need not be taken up for controlling. After comparing the actual performance against the standards and finding the deviations, the next step should be to correct these deviations. It is important to determine the correct causes for deviation. The causes of deviation may be of different types, such as improper equipment and machinery, lack of employee motivation, lack of training, improper system of compensation or remuneration of employees, etc. The corrective action depends on the nature of causes of variation. Corrective action should be taken as early as possible so that the normal position can be restored quickly. Some variations are desirable, such as expenses below the standard, but some other variations are undesirable, such as, say, a low inventory turnover ratio. But in any case, the causes of variation need to be analyzed. Three basic types of control are feedback control, concurrent control, and feed-forward control. Feedback control is a mechanism for gathering information about performance deficiencies after they occur. This information is then used to correct the performance or prevent performance deficiencies in future. Feedback control involves gathering information about a completed activity and using this information to improve the similar activities in future. Management control is often perceived as the feedback system as shown in the feedback control loop. Managers do measure actual performance, compare these measurements against standards, and identify and analyze deviations. But it is also important that a program of corrective measures is developed and also corrections are implemented. Otherwise, the desired results cannot be achieved. Concurrent control involves identifying and preventing deficiencies as they occur. A driver adjusting the steering of a car continuously can be regarded as an example of concurrent controlling. Supermarkets and department stores have electronic cash registers in operation that immediately transmit data on every sale to a central data storage facility. This will provide the store manager on a real-time basis the details of material or stock available in store, sales, profit, etc. Similarly, a factory manager can have a system that reports at any time the status of production programs in terms of, say, production volume, labor hours accumulated, inventory usage, etc. In the context of management control, even though real-time gathering of information as well as comparison of this data may be possible, the analysis of the causes of deviation and the program for implementing the corrective measures may be time-consuming. Feed-forward control is a mechanism for preventing performance deficiencies before they occur by ascertaining whether performance inputs are as planned. If not, the inputs or perhaps the process alterations are made to get the desired output. Feed-forward controls are future-directed. They attempt to detect and anticipate problems or deviations from the standards in advance of their occurrence. Feed-forward control requires development of a model with well-defined input variables and their interrelationships, thereby enabling the prediction of end result. It is important that the model is periodically updated. In the case of feedback control, output performance is measured and compared against the standard, and in case of performance deficiencies, necessary alterations are made in the input as well as process. Feed-forward control is based on a developed model that uses input parameters for the prediction of end result. Based on the prediction of output performance, necessary alterations are made in the inputs as well as process. In the case of feed-forward control, the information flow is at the input side. On the other hand, in the case of feedback control, the information flow is at the output side. In both cases, the corrective measures are directed towards the inputs as well as the process. Even with a feed-forward system, a manager would still want to measure final system output to ensure the actual performance is as per the standards. There are a number of techniques or tools that help a manager in effective controlling. Some of the control techniques used by organizations are personal observation, financial statements, budgetary control, break-even analysis, return on investment, and network techniques. Personal observation is the most traditional and most popular method of control. Manager observes the actual performance of the subordinates at workplace and note down their observations. The observations are analyzed to prepare performance report of employees. By comparing the performance report of current year with that of previous years, the managers can know the progress of employees. Comparison can also be made among different employees working at the same level of organization. Employees try to perform better when they know they are observed personally by their superior. However, personal observation may have a negative impact in some cases, as self-motivated employees need not like to be closely supervised. This technique is time-consuming. Financial statement refers to the monetary analysis of the flow of goods and services to, within, and from the organization. There are two basic financial statements connected with any organization, namely balance sheet and trading and profit and loss account. The balance sheet describes the company in terms of its assets, liabilities, and net worth, as at the date of its preparation. And the accounting equation defining the balance sheet is assets minus liabilities equals net worth. Assets are things owned by the company and the liabilities are the obligations to the company. While the balance sheet describes the company's financial condition at a given point in time, the trading and profit and loss account summarizes the company's performance over a given interval of time, say budget period or financial year, and is defined by the accounting equation revenue minus expenses equals profit or loss. The financial statements of the current year can be compared with the previous year's statements. They can also be compared with that of other similar organizations. Ratios derived from financial statements, often referred to as financial ratios, can also be used for controlling. Ratio basically is a comparison of two numbers with respect to each other. For example, inventory turnover ratio is the ratio of cost of goods sold to average inventory. A high inventory turnover ratio means that the company is able to move its inventory quickly. On the other hand, a low inventory turnover ratio usually means either the company is purchasing too much inventory or having problems in selling the products. Break-even analysis is another tool of control available to management. Cost or expense associated with any production activity can be split into two components, namely fixed cost and variable cost. Fixed cost is independent of volume of production. That is, even with zero production or no quantity produced, the company will have to bear this expense. With the increase of production level also, this cost will remain constant. Land, building, equipment, etc. are examples of fixed cost. Variable cost varies with volume of production, and material cost, labor cost, etc. are examples of variable cost. Total cost or expense associated with production is the sum of these two cost components. If F is the fixed cost, V the variable cost of producing one unit of a product, and Q the production level or number of quantities produced, then total cost or expense equals F plus VQ. This is an equation of a straight line with F as the y-intercept and V as the slope of the line. If P is the selling price of one unit of a product, then revenue generated by selling Q units will be equal to PQ. This is an equation of a straight line starting from origin with slope SP. Break-even point corresponds to the point of intersection of the total cost line and revenue line. That is, at the break-even point, total cost or expense equal to revenue. Considering the quantity or volume of production at break-even point as QBEP, that is quantity corresponding to break-even point, F plus V into QBEP equals P into QBEP, or in other words, QBEP equals F divided by P minus P. This is the production level at which the firm neither incurs a loss nor enjoy a profit and is referred to as the break-even point. Operating below the break-even point, the company incurs loss. Operating above the break-even point, the company will enjoy profit. At the break-even point, the company will neither have a profit nor a loss. Always efforts must be made to keep the break-even production level as low as possible, and this can be achieved by three methods, namely reducing fixed cost F, increasing selling price P, decreasing the variable cost V. Only after crossing the break-even point, the company will start realizing profits. Budgetary control is a process of setting financial and performance goals with budgets, comparing the actual results, and correcting the performance if needed. Budget is a quantitative plan which is established for the forthcoming period of time, usually a year. Budgets generally takes into consideration expenses to be met, planned sales, expected revenue to be generated, and flow of cash and cash equivalents during the set time period. Financial budget is the budget for balance sheet elements. In other words, financial budgets deals with the expected assets, liabilities, and stockholders' equity. Operating budget indicates the goods and services the organization expects to consume in a budget period. Expense budget explains where money will be applied. Revenue budget is for projected sales revenue and is used to measure marketing and sales effectiveness. Profit budget or master budget combines expense and revenue budgets in one unit. Engineered cost budget is a type of expense budget that describes material and labor cost of each item produced, including estimated overhead costs. Discretionary cost budget is a type of expense budget that is used for departments in which output cannot be accurately measured. At stated intervals during the set time period, actual performance will be compared directly with the budget. Deviations, if any, can be detected and acted upon. Return on investment, ROI, is another technique of controlling. ROI refers to the rate of return the company or departments earn on the allocated capital. For an investment of $1,000, if the revenue generated is $1,080, then return on investment is $80 or 8%. ROI can be compared over the years and also between the departments. Profit on the investment is a reward for risk taking. If the ROI is high, then the financial performance of a business is good and vice versa. Network technique is a powerful tool in controlling. Network is a logical representation of events and activities required to complete a given project. Activity represents a job and is the time-consuming part of the project. Activity is denoted by an arrow in a network. Event marks the beginning and end of an activity and does not consume any time. Event in a network is denoted by a circle. Two of the popular network techniques are program evaluation and review technique, PERT, and critical path method, CPM. The first step in network analysis is to break down a given project into a number of activities, arrange these activities in logical sequence, and thereby draw the network. Also, time dimensions need to be assigned for these activities. The distinction between PERT and CPM is that PERT is event-oriented and CPM is activity-oriented. Also, in CPM, a single time is assigned to activities, whereas in PERT, 3 time estimates, namely optimistic, most likely, and pessimistic time, are assigned to activities, and based on these time estimates, expected or average activity times are calculated. CPM is a deterministic model, whereas PERT is a probabilistic model. A project will be over only after all the activities and events in a network are complete. Figure shows a CPM network, and there are 3 paths connecting initial and final events. Time dimensions are in days. As per the network diagram, activities 2.3, 2.4 and 2.5 can start only after the completion of activity 1.2. But these 3 activities can be carried out parallelly. Likewise, all other activities are arranged logically. The duration of the 3 paths connecting initial event and final event are 15, 16 and 18 days. The path that consumes maximum duration is called the critical path, and in the network 1, 2, 5, 8, 9 is the critical path. Duration of the critical path is 18 days, and this corresponds to the project duration. If any of the activities along the critical path are delayed, the project will get delayed. This is because project duration is decided by the critical path. So control is required for activities along the critical path. Managers use a variety of approaches to ensure actual performance conforms to plans. The outcome of plans is dependent on the people who implement them. Causes of negative deviations could be factors like lack of knowledge, lack of experience, poor judgment, etc. There are 2 ways to ensure responsible people modify future actions. These are number 1, direct control, and number 2, preventive control. Under direct control, the procedure is to trace the cause of an unsatisfactory result back to the persons responsible for it and get them to correct their practices. Direct control is based on the assumption that all performance can be measured, personal responsibility exists, time expenditure is warranted, mistakes can be discovered in time, person responsible will take corrective steps. Preventive control is based on the idea that most of the negative deviations from standards can be overcome by applying the fundamentals of management. The principle of preventive control is that the higher the quality of managers and their subordinates, the less will be the need for direct controls. The preventive control is based on the following assumptions. Qualified managers make a minimum of errors. The management fundamentals can be used to measure performance. Application of management fundamentals can be evaluated. Some of the features of an effective control system are flexibility. Control system should be flexible to adjust to the changing environmental conditions. Acceptability. The designed control system should be acceptable to the organization's members. Critical point control. Rather than controlling every activity, control system should focus on critical activities that will have an impact on achieving organizational objectives. Objective standards. A control system will be effective only if standards of performance are framed objectively. Standards should be specific, quantified, and attainable. economical. The cost of control system must be balanced against its benefits. The system must be economically feasible and reasonable to operate. Control by exception. A good system of control should work on the exception principle so that deviations beyond the acceptable limit are only brought to the attention of the management. Timeliness. Deviations must be reported promptly to the management so that timely remedial action can be taken. An effective monitoring system should provide timely information. Future-oriented. The control system should ensure that mistakes made in the past are not repeated in future. The control system should not only find deviations but also correct the deviations. Simplicity. The control mechanism should be simple and easy to understand. Publicity. The result of the control should be made known to the performers. Some of the advantages of controlling are reduced wastage, optimum utilization of resources, prompt corrective action, helps to fix responsibility, simplifies supervision. Some of the disadvantages include difficulty in setting qualitative standards, no control over external factors, dissatisfaction among employees, reduced employee freedom, and involves time and expenditure. Planning and controlling are two separate functions of management, but they are closely related. Plans are prepared for future and involves looking ahead, and as such is called a forward-looking function. On the contrary, controlling is like a post-mortem of past activities to find out deviations from the standards. In that sense, controlling is a backward-looking function. However, it should be understood that planning is guided by the past experiences and the corrective action initiated by control function aims to improve future performance. Thus, planning and controlling are both backward-looking as well as forward-looking functions.